Good morning, everybody, and welcome to today's Monday morning mortgage update. My name is Sean Wohland with Waterstone Mortgage and the Wohland Mortgage team, and we're going to jump right into what's happening in the markets. But before we do that, we're going to start off with a little humor. We're going to highlight a mortgage product, and then we'll jump right into what's happening with mortgage rates and what's happening this week. So let's jump right in and start with the joke of the week. So as you know, I like to have some humor in this world. We all need to laugh a little more. So here's the joke. Why are some loan officers always so sad? They are always alone. Yes, it's bad. I know it's bad. So let's move on. So the loan product spotlight, this is near and dear to my heart because it helps a lot of real estate agents. This product is fantastic for those people who are self-employed that write off everything. They try to show as little taxable income as possible. But it hurts because you can't qualify for a mortgage that you want. This product is called a no ratio loan. There is no income and no employment on the application at all. It's left completely blank. So if you can't verify income via bank statements and you want to just leave all income out completely, including your job, there's no employment, there's nothing on the application regarding income or employment. It's blank. This is your loan product. 25% down is required. We do verify the assets. It's primary home only, and you do need at least a 720 credit score. But this is a great loan for those people that write off everything. Still want to qualify. The rates are a little bit higher than a traditional mortgage, around 1.5% higher in rate. Not terrible, but it's a great loan product. So if you're looking to buy a home and you haven't been able to, or you have some customers that just can't qualify because they can't show the income, but they have a good down payment, this is the loan for them. All right, so let's jump right in with what's happening this week. So three big things. We have Inflation Nation, basically what the CPI is going to be showing. We're going to have Powell talking on Tuesday about that. A little bit of domestic flavor. We have retail sales. That's going to be interesting to see. It should be a little bit weaker than expected, but we'll keep our eye on that. If it's weaker, that would help mortgage rates. And then geopolitical, we have a big meeting that's potentially happening on Friday between Putin and Trump. It's all about the war in Ukraine. So that's going to be really, really interesting to watch. In regard to the CPI, this is going to be very interesting because overall CPI isn't bad, but we'll look at the numbers that we're going to be replacing because it is an average. So current year over year, the headline is 2.67. In June, it came in at 0.29. Well, last July, the number was very low. So this July number is going to be replacing a 0.14 number. So if it's above 0.14, the overall average for the current year over year will go up. Even if it's a low number overall, if it's higher than 0.14, inflation will go up for the year over year number. Core is at 2.93 year over year. In June, it was 0.23. Last July of 2024 was 0.19. Again, if we get a number tomorrow that's above 0.19, the core will go up. Even if it's 0.20, which is a really low inflation number, it's going to show an average of it going up. So we'll keep an eye on that. The July 25th month over month estimate is between 0.16 and 0.2. So yes, we most likely will see inflation creep up a little bit over the year over year tomorrow. July 25 year over year estimate is going to go up between 2.7 and 2.8. So there'll be a flat change to 0.1 change tomorrow. We'll see what that looks like. Core CPI is slated to do the same. So we'll keep an eye on that. Higher inflation typically means higher rates, but overall the inflation numbers aren't bad. They're actually pretty good, but the overall year over year average, because we're replacing such a low number, will force it to go up just a little bit. So let's look at the charts. As you can see here, we had a pretty significant move from the middle of July up to where we are today. We fell a little bit last week in the mortgage-backed security world on the 30-year universal mortgage-backed securities. We lost about 35 to 40 basis points last week. We landed right on this line. If you can see this, we went above it right here. We tried to go higher and we bounced back down, but we held our ground right there. We said, hold the line, and we did. We held it 1, 2, 3. We held at 4, and we hold it our 5th day in a row of holding that. So that's a good solid floor of resistance. Hopefully we'll get some good news tomorrow, and we'll see the mortgage-backed securities continue to go upwards, which means rates will come down. Let's look to see what the 10-year has done. We saw a nice big drop in the 10-year from the middle of July, and we had one really good day. That's the jobs numbers when they came out, and that was a really good day. Remember, weak jobs numbers is good for mortgage-backed securities. It makes the 10-year drop. When the 10-year drops, mortgage rates drop. We went below this level here, and then we came back up, but we're holding next on that Fibonacci level. So we're holding tight there, so hopefully we'll rebound down. So the best rates in the month happened last week, at the beginning of the week. They got a little bit worse since then, but overall rates are still in a better picture than they were several weeks ago. Here's a current snapshot of where rates are at. Mid 6s for 30-year fixed. Yep, you have to be perfect. 500,000 loan, primary home, 25% down with a 780 FICO. So if you're different than that, your rate will probably be higher. But 15 years just under 6% now. That always looks good. And then adjustable rate mortgages are in the low 6s, but only if you put 25% or more down. Once you do less than 20% down on ARMs, they just don't make sense. Then FHA is in the low 6s, which is always a good thing for those first-time home buyers. And of course, the VA, our veterans, nice low number in the low 6s. So rates are pretty good. A lot of people coming out of the woodwork wanting to refinance. It's not a huge difference to where a lot of people are. A lot of people are in the high 6s, maybe low 7s. So we may need a little bit more time to see that, but overall, we are looking good. But what's the future look like? Future looks like, as far as the forecast, Fannie Mae says in Q3 we'll be right around 6.5. We're almost there now. And we're somewhat in that Q3 already. Q4, 6.4. Look at next year though. First quarter, 6.2, and then 6.1. The Mortgage Bankers Association doesn't give it as much love. It thinks we're going to be pretty darn flat through quarter of next year. So if you have people waiting, it's not going to get much better. Okay, it's fractions slower. So if people are waiting for a 4% for the next 6 months, it's not going to happen. It may. Odds are very low, but it may. So keep an eye on what's happening in the markets. Let your buyers know that yes, mortgage rates are supposed to come down, but not by a lot. It will help. Having a rate at 6% with no points is going to be nice. It'll help a lot of people, especially those people that have rates in the 7s and 8s that they closed a year or two ago. But we're not going to see rates in the 3 or 4s anytime soon. So if you have anyone waiting, send them this slide.